When time decay works against you, when does time decay work against you, Mike? Can you name a couple points?
I can.
Yes.
If you're buying options.
Just YOLOing long options.
That's
certainly one.
Going to be a slow trickle.
Yes.
Or a fast trickle if you're in a near-term cycle. And that's just extrinsic value decay. So again, we've talked about extrinsic value, how it rules the world. If you understand extrinsic value, you understand 80% of the stuff we're talking about.
You'll know exactly what this is about.
Yes. Another one is credit spreads.
Yes.
If they're in the money, there can be and is some decay against you. But a lot of people don't consider that when they think of selling a spread. It can go from positive theta to negative theta, which again is just an understanding. Bless you.
Thank you.
An understanding of extrinsic value. So, a couple of things here, but yeah, it's certainly important to understand when this can happen. And although there's no preventing it, it does explain why credit spreads have different rolling mechanics than an undefined risk trade, which I think is a hidden takeaway from this.
Good stuff.
Beautiful.
Shall we?
Dive in. The primary motivation for traders is to sell options, especially if you're watching the Tasty Network. We talk about this all the time. Higher probability trading. You don't have to be directionally right to still make money, et cetera, et cetera. Whether it's naked puts, calls, strangles, or iron condors, the whole goal is to collect premium. This allows premium sellers to generate profit as time passes, even when the underlying price remains unchanged. And this is due to the natural option premium depreciation over time or depreciation over time. And yeah, all extrinsic value goes to zero, regardless of whether the option is in the money or out of the money. But there are different implications for different types of strategies, and we will break them down right now. Premium depreciation is an ongoing.
You're having trouble with the depreciation.
I keep
don't defecate on it, okay? Please.
Depreciation.
Depreciation, yeah.
Depreciation. Throw an extra I in there, is an ongoing process that continues until expiration. Of course, it benefits premium sellers through positive theta. When theta is positive, traders can collect time value and extrinsic value decay in their favor, regardless of stock price movements or implied volatility levels. But again, it does not apply uniformly to risk-defined strategies, because you are selling an option to define the risk. You are also buying an option.
Yes.
And like we just stated, long options have negative theta.
And extrinsic value. It all comes down to which one of those options has more extrinsic value. If your long options have more extrinsic value, meaning they're closer at the money, you're going to have a decay against you because those are going to have more value decay that you are long.
Yep. Naked options positions maintain positive theta through their entire lifespan, even when a position shows unrealized losses. Negative P&L gradually diminishes as the position collects incremental time value each day. So yes, with a risk-defined strategy, your positive theta zone is literally when the stock is between your short options.
Yes.
Because that confirms that your short options will have more extrinsic value than your long options. If you're just thinking about it that way, short options, when the stock is between them, they will have more extrinsic value than your long options that are further out of the money, because further out of the money options have less extrinsic value overall.
Yeah. And you really need it to be kind of right in the middle for decay to come in, because in the short term, and you could see it here in the curves that we have for the positive theta, like day zero, you need it to be right at the in the middle of those strikes, because as the stock moves, one spread is going to gain delta, or changes in volatility are also going to come into play. But you're gonna, if the stock moves up, your put spread's gonna it make you $5, and your call spread's gonna lose you $5. Like it's a lot of, you really need it right in the middle for both of those spreads to really decay, and that's why iron condors, it takes some time to get for that extrinsic value to come out, as long as the stock kind of moves in a tight range here. Another thing I wanted to point out here in this visual, it's cool because with iron condors, and we talk about this a lot, when you put on a $10 wide iron condor like that one I did in Visa, it's going to actually lean slightly short delta if you're going to the same delta on either side, because The skew is in a lot of stocks to the downside. So when you're adjusting these to be neutral, your put spread is typically going to be further out of the money than your call spread. And you could see that here in that the put spread and the break even on the downside is further away than on the upside, the call side, because of that difference in skew.
Yep, totally. And another call out here, when you're looking at naked option strategies specifically, it doesn't matter whether the option is in the money or out of the money, because you don't have that long premium component that's decaying against you. And that long premium component in a spread, of course, like we've been saying, can have more extrinsic value than your short option if it moves in the money, because extrinsic value is just this umbrella that follows the stock price. Doesn't matter whether you have, a short put on with a put spread or just short put. Like, the extrinsic value is going to decay. It's just a matter of how much extrinsic value there is relative to your short option. But if you have a strangle or a straddle or a short put or a short call, if it's out of the money, at the money, in the money, it's still going to decay in your favor, because all extrinsic value goes to zero by expiration, and short options have that theta decay working in your favor. So if you have a in the money put or call with 20 days left, if the stock price is right there at expiration, your P&L will have a less of a loss because extrinsic value is moving in your favor. Not always the case with spreads, which we'll take a look at next.
Next slide, please.
So yeah, risk-defined strategies like iron condors exhibit more complex theta behavior. And again, it's simply because when you have long options that are there to define your risk, if the stock price moves to a point where your long options have more extrinsic value than your shorts. And another thing to call out here is, if you have a short put spread that goes completely in the money, or a short call spread that's completely in the money, your short option will have a higher value overall, because it will have intrinsic value, more intrinsic value than the defining risk long option. But again, it's all about extrinsic value. It doesn't matter what your intrinsic value is. This theta number is all about extrinsic value. It has nothing to do with intrinsic value.
This one is also cool because it shows we get that email all the time, like where the stock rallies and it's still, your iron condor is still out of money, but you're not making any money at 21 days. And that's because when you get closer to at the money on either side, the decay component has come in your favor. Like, that has happened. 20 days or 21 days have passed, but it comes down to the at the money options. And when you're, that call spread that you sold, it's going to buffer you to the downside. But if your put spread is right at the money, you're still probably going to be at a scratch or maybe a small loss on that position, even if it's 21 days and even if the stock is quote unquote in the middle of your spread. It's important to understand that when you're looking at an iron condor, it's much tighter a range than just the binary risk profile that you see in terms of the 21-day mark. And that's why a lot of times with iron condors, you might have to hold these past that 21-day mark. And while, with single spreads, if you're short a put spread, short a call spread, whatever, you might have to hold it a little bit extra, even if it's in the quote unquote in the middle. E-mini's only up 4.
Yeah, NASDAQ just ticked red.
Ooh, scary. Next slide, please.
Sweet. So outside the zone, theta becomes negative in 2 distinct areas. So traders will lose more day to day when holding these losing credit spread positions that are in the money for too long, even though the credit was initially collected at order entry. So again, it's because your long option has more extrinsic value than your short, and that long option losing extrinsic value basically gets you closer to the intrinsic value loss of the position. So one nice thing about spreads that move in the money, especially ones that have 25 days, 30 days left, they're not going to be trading for pure intrinsic value. If you have a 10-point wide spread that's completely in the money, you will see that it's not trading for $10 until expiration, because your long option is preventing you from realizing max loss because it has extrinsic value.
Extrinsic value increases. Yeah.
So that's one of the nice things about a spread. And we talk about this all the time. Like, if we have a put spread or an iron condor on and it gets totally blown out, it's in the money, we're just going to hold on to that position because we know our risk is defined. We know that, yes, theta will be ticking against us. And day to day, if nothing changes, we're going to get closer and closer to that intrinsic value loss. But we're already realizing a pretty substantial loss, and we can only lose a little bit more. We can make a lot more back if there's a directional move in the stock. So positive theta between the strikes for defined risk credit spreads. Negative theta, you will see that when the spread moves completely in the money. Now, this also explains why you can't roll an in-the-money credit spread for a credit, because if you're moving those strikes further out in time and you know that your long option has more extrinsic value than your short option, what does that mean when you're moving it out in time? It means that you're paying a debit because you're paying for more extrinsic value in your long and you're collecting in your short, even though your short option has more real total value, intrinsic plus extrinsic. Your long option has more extrinsic than intrinsic compared to your short.
Perfectly said.
To understand how theta evolves through an iron condor's life cycle, we analyze 45-day SPY iron condors. So we're just going to look at this in practice, short the 20 delta strikes, and then we're going to define the risk 1 point wide and 5 points wide beyond those short strikes. No position adjustments, and just recording the daily theta change. There's some interesting takeaways here.
Yeah, these two slides are pretty cool. I think it explains why sometimes you have to hold these, and we're going to look at them here. So
Yep.
let's jump into it. Slide 7, please.
Okay, so the analysis shows that iron condors can have both positive and negative theta values depending on where the market price is relative to the iron condor. So again, if the market price is between the strikes, you're going to have positive theta. If the strikes move in the money, it's going to have a negative theta reading. Positive theta represents positions performing well, like we just stated, but negative theta indicates that you will have it in the money spread. Simple as that. One thing that's interesting about this is the 20 delta $1 wide iron condors. So look at how narrow this band is from 45 days till it starts to get crazy near expiration.
Yeah.
There's almost no change in your theta value, which also speaks to the fact that you might hear us say like really narrow spreads are Greekless.
Yes.
And that's because the closer your short option is to your long option, the closer those options Greeks are going to be as well. So you could have a 60 delta option, but if you're looking at buying an option 1 point away, it might be a 59 delta option or 58. Like the deltas are offset, the more narrow your spread is. Same with theta.
Yep. And those things become even more elevated, like specifically with put side. If you're doing $1 wides in SPY or something like that, if you're tested on those, you're probably seeing volatility expand too. So those options move, the raw value of those options get bigger and bigger. So those spreads, they really don't move all that much.
Yeah, they're really very binary in the sense you just had to hold them until all theta decay.
And they got to be out of the money.
Yeah.
Yeah. No management, basically.
So the next slide, you will see a similar image, but wider ranges. So this is the same 20 delta short options with 5 point wide wings. So biggest takeaway for me here is that the theta range is significantly wider compared to the other one. And this is well before expiration.
Yeah.
So you can see the positive and negative theta readings are wider, and it still is crazy when you get closer to expiration because you're dealing with options that have, very, very dynamic theta and very dynamic extrinsic value. It's flying around. Yeah. But this is the biggest takeaway for me is that the $5 wide iron condors can have a bigger theta range. And again, it's because your $5 wide spread is 5 points away compared to a 1 point away long option. And that means your deltas are going to be different. Your thetas are going to be different between your short and long option, which enables this to have more of a Greek exposure compared to a 1 point wide spread.
Yeah. And $5 wide really isn't even that wide either. Yeah. I mean, like this, change in these two charts, you can extrapolate that out to even wider spreads. And it tells the story of why we look for those 10 or 20 or 15 point wide spreads, as opposed to doing 15 $1 wide spreads that just won't move until expiration.
Yep.
Next slide, please.
So, testing across various iron condors reveals a clear relationship. Wider wings result in fewer days with negative theta. So why is that? You're looking at a 1 point wide spread. You basically, if your spread's in the money, it's completely in the money.
And it's going to be negative theta.
Yeah.
If it's fully in the money.
Yep. $5 wide spread, harder to go completely in the money. You now need a bigger move in the stock price for a 5-point wide spread to go completely in the money. And same thing with the 10-point wide spread. So the wider your wings are, number one, the more Greek exposure you're going to have, because your short options now have a much bigger exposure to those to the Greek figures there relative to your longs, because your longs are much further out of the money. You also have more range for you to maintain positive theta, because for a 20-point wide spread to go completely in the money takes a lot more out of that stock price compared to a 1-point wide spread. So the wider your wings are, and this really emphasizes why, if you're doing 20 $1 wide spreads, you are doing yourself a disservice as opposed to just doing one 20-point wide spread.
Yes.
Because not only are you going to have way better break evens, your 20 contracts for $1 wide or 4 contracts for $5 wide, your max loss is so much closer to the current stock price than one 20-point wide iron condor, where the stock literally has to go significantly further away, and you're still going to be in a profit zone or a scratch where you're realizing max loss on those other strategies. So almost every time, instead of doing multiples of a $1 or $5 wide, we're going to do one contract of a wider spread.
And everybody focuses, or a lot of times focuses on the marginal difference in the credit. Like if you did 10 $1 wide spreads for 50 cents, you might only get $4 for the $10 wide. Yeah. You know, and they'll say, well, I'm getting more premium for the same amount of risk. And that's because your risk, where your $500 or $600 or $700 of risk is significantly closer and a higher probability of realizing that max risk relative to the 10-point wide, where yes, you give up 50 cents or $1 in premium, but your risk, the probability of you realizing that same amount of risk is maybe 10 or 15%, whereas the $1 wide might be 30% or 40% or 50% of realizing that big max loss. And so we're always going wider versus tighter and more contracts.
100%.
Last slide for takeaways.
Takeaways here. Iron condors don't always benefit from time decay because they are defined risk trades. So that applies to any defined risk trade that you route for a credit. It can eventually tick against you in theta if it moves in the money. Time works in our favor, but only when the stock stays in the middle of the range or out of the money. So even if you just sell a put spread or just sell a call spread, if the spread is out of the money, it's going to be ticking in your favor. If the stock moves too far and that spread moves in the money, we lose money from both the direction working against us and time working against us. So this is another scenario where, if I have a credit spread that's completely in the money, not only am I seeing negative theta, but I now need a delta move to move it back out of the money. So if we're rolling credit spreads to defend them, we have to roll them before they move completely in the money. And that's really it. Like, it's not about 21 days. It's not about 14 days rolling, whatever. It's about where is the stock price relative to the strike price. And I need to make sure I'm rolling before it goes in the money if I'm trying to defend it for a credit. And last but not least, certainly not least, using wider spreads is going to give you better results, especially if you're doing multiples of narrow spreads compared to just one wider spread. And someone in the YouTube chat called out, not to mention commissions and fees too. Yeah.
It's another factor. Yes.
Yeah, totally. So yeah, using wider spreads, especially if you're doing multiples of a 1 or 5-point wide spread, knocking that down to one contract and making it as wide in terms of max risk will not only reduce your max loss probabilities, but it gives you a better Greek exposure, it gives you better break evens, and it's just an overall higher probability trade.